Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, May 30th, 2019. I wanted to do a quick market update and more so just kind of trading tips, trading investing tips, things that I look at and things I'm watching right now. I'll start out here with the daily charts quickly. I want to spend more time on the intraday charts. So far, we hit, as I mentioned, SPY hit a couple support levels yesterday. It hit the 200-day exponential moving average. That's the red line here. And also, I had the next support level down here, 277.53. Hit that and bounced off that. And we're above it so far, but we're pinched between a rock and a hard place, between support and resistance. Remember that 280 level was pretty big right there. You can see it. You can see the reactions right here. Big reaction back here, major reaction low. The first leg down in this correction on the 13th. Came close there, then hit it again the other day, closed right on it on, what would that have been, Tuesday? Yeah, Tuesday's candle, gap down below it yesterday, so now we're back testing from below. So very big level. I also put those levels out in the pre-market update this morning with the charts. Now, the takeaway from this is a couple things. I want to just speak fundamentally. Back here a few weeks ago, a few months ago, in the videos leading up to the high, at this point here, I was looking for a correction. We got a couple small corrections. At this point, I said I'm no longer looking for a 3%, 4% pullback, looking for something deeper. And at the time, if you recall, and it wasn't so long ago, it was only, what is that in time? A month ago. Markets were making new all-time highs in the QQQ. SPY popped the previous high briefly there. And everybody was about as bullish as you can get. I'm talking about reading the headlines, why there wasn't even a remote chance of a recession in 2019. I'm talking consensus here. There's always somebody on the outlier calling for something different than everybody else, but the vast majority of economists and market experts, said higher highs throughout 2019 in the market, no recession in sight, maybe down the road, 2020 plus. Now, when I scanned the headlines last night, man, I'll tell you, economic expectations are plunging. You hear the word recession come up a lot more. And I said that's what would happen. I said the charts will go first, and the news flow will always follow the charts. That's one thing that I can guarantee you. So right now, well, last night, the headlines read about as bearish as you could get. I have mixed feelings on that. Number one, it maybe near term might give us a bottom because, like I said, everything that I read is bearish. The articles are bearish. Investors are bearish right now. That's called recency bias. When everything's going up, investors and traders tend to be bullish, no matter how overbought, no matter how glaring the sell signals are. They're looking at the recent trend. So now I'm back on topic here. So basically, what's happening is more and more of the expectations that I've had and the things that I'm looking are rolling over. The market's rolling over with economic expectations. And I said that would happen. That's one guarantee I will give you in trading and investing, that consumer confidence tracks the stock market. The Fed even, back when Bernanke was running the Fed, he even said that was one reason they were going to gun the market up with quantitative easing to boost consumer confidence, which would then boost consumer spending, which is 2/3 of GDP, and bring the economy up. So by bringing the stock market up, you buoy the consumer confidence, and then the rest follows. Now it cuts both ways. You go down, consumer confidence drops, therefore consumers they tighten their wallets, and it's a downward spiral, a vicious cycle. Now, this is again, as I said, it's a bigger drop in the S&P or the Nasdaq 100. It's not a huge drop so far. It's just a run-of-the-mill correction. Run-of-the-mill correction so far, for the most part, in SPY right now. About 5-6%. But what I noticed today too, and what seemed to knock the market down around 10 o'clock, it was technically driven, but there was also on the economic front, you watch the economic calendar, pending home sales came in well below expectations. The consensus was a gain of 0.5%, and we got a drop of 1.5% month over month. Now, if you remember, I don't know if there's a lot of new people to the site coming in all the time. I did more of a fundamental video. Technical analysis is watching charts, predicting where prices go based on the charts and what you see there. And fundamental is, why the economy should go up or down based on, of course, fundamental reasons, macroeconomics and all that. And what I had said at the time is there's, what's driving the market, what's holding this market up is the consumer. Again, roughly two-thirds of GDP, gross domestic product. And I said right now there's three pillars keeping the consumer strong, spending, keeping the market going, keeping the economy going. And that is first and foremost the stock market being up near all-time record highs, obviously, huge gains in the past 10 years. So if that starts to crumble and reverse, that will quickly dampen that one-third, or that one of the three components of consumer confidence. The other being the job market, which, as I said, very strong, but I've also gone over this in recent videos, as well as some upfront static charts on the site that I showed you. We're at levels where, going back historically, and we're talking decades, that's where recessions start. They don't start at high, they end at high unemployment, at record high unemployment. They begin at record low unemployment. So it's a double-edged sword. It doesn't mean just because we've hit those record lows, we're at the same level where recessions have started in the past. It doesn't mean that has to trigger a recession. You can stay low, you can go a little lower, you can break records, but we're down at that low end of the range. In other words, the job market can, for the most part, can only get worse from here. Let's just keep it that simple. So there's the second component. Now that's still holding up, though that data is a little bit lagging, but we'll continue to monitor that. And then I said the third component of the consumer is your house. In fact, and I put up a study that shows, a chart that shows for the majority of Americans, their home is their most valuable asset. The uber wealthy, Bill Gates, Donald Trump, you pick a name, the majority of their net worth is in their financial assets, their stock holdings and things like that, and real estate. But for the majority, the average Joe, middle class, their home is their most valuable. They have more equity and value in their home than they do in their 401k and their savings. So that's the pillar, and again, I'm watching that, and I'm seeing, and I've talked about it again, did a whole video on it. So that obviously, today's pending home sales index number was not good. So keep that in mind, and it's just a trend to follow. Okay, so enough on the longer term stuff. Let's drill down to the intraday charts before I do that. QQQ, remember, also came very close to the 200-day EMA, reversed a little bit above it, but did hit that 175.66 support level right here, and closed above it after a brief intraday undercut. So we still have these wedges, and now let's drill down to this and take a look here. Okay, so before the market opened this morning, I updated this chart. These are the same potential bounce targets that I've listed earlier this week, or was it late last week? Here's the bullish falling wedge, the bullish divergence. If we didn't have all these cross currents, the long term, primarily the breakdowns, forget about economics and the news, everything I just talked about, that doesn't matter to me one bit. That will follow. The news headlines will follow the markets. In fact, when everything gets pretty bearish, that's usually when you get your bounces. Even if you're going in a bear market, the news flows in the market will ebb and flow. The headlines, that is. But what's happened recently, we had the major breakdowns on the weekly charts. A lot of stocks, market-leading stocks, breaking down on both the daily and weekly time frames. So if that hadn't have happened, if we were still uptrending, even if the market was overbought, like I had my concerns a few months ago, I would be all over this like white on rice as far as long trades, this bullish falling wedge, bullish divergences, and certainly have this as an official trade idea. Right now, however, I have my concerns, and this is what I was talking about. Once the tide turns, if this is what I suspect it may very well be, going back to the weekly charts, the beginning of the next leg down in a much larger bear market, a bear market that started back here with a 20-something% drop in QQQ, this simply being a bear market rally, and then another leg down to come. If that's what this is, the problem with bullish chart patterns is they simply either don't work or they start to play out just as it looks to get going. If we break out here, they sell into it. If this thing can't even break out, if these divergences just dissipate, if they're taken out, if this wedge even fails to have a breakout and we have another major leg down, it is going to tell me that this market is pretty much done, that we are in just the early stages. And I guess that's a takeaway from this. For those that said, oh, well, I wish I should have took my 401k money out here when, Randy, when you said that weekly trend line broke and the daily trend lines and all that, and we had the short entry on QQQ, but it's too oversold now. I'll just wait till we get back up there. We may never get back up there. In fact, we could drop another 5-10% before we bounce the 3 to 6 that I'm looking for right now. I just want to say that is a possibility. These are ugly charts, and if this fails to play out, that's going to tell me the nature of this correction, that hey, we're probably in the early stages of a much deeper correction. So keep that in mind. So the levels that I posted this morning, so I called it the 177.20-ish level. That line's right at 177.17, and this is a takeaway too for trading. So here's what I watch. I said we need to break that level and the downtrend line, which comes in just slightly above it on QQQ. Let's tighten that up a little. There's a downtrend line. So if you break 177.20, you're going to break the downtrend line as well. It would be a buy signal, and a pretty solid one, about as good as it gets. Like I said, if you, of course, you have those long-term charts, that kind of takes away from it. But again, just take it on face value if it happens. However, as I always say, support or resistance is resistance until unless broken. So let's look what happened today since we opened. So we gapped up. Here's 177.20. We hit it once, failed. Hit it twice, failed. Hit it 3 times, tried to pop it on this is just a 1-minute chart, briefly, failed, and then they've been selling it since. So what happened is the shorts became emboldened. They saw 3 failed attempts at a key level. And I'll tell you, the fact that this is the earliest, the shallowest bounce target that I have, the first resistance level, and we couldn't even clear that so far, not good. Now the day isn't over. The Qs are still up. I will tell you, I am still leaning towards a breakout above that level. But when I keep seeing this happen, these failed, every little pop into resistance getting sold into, it certainly doesn't strengthen my conviction. But I'll let you know when I've abandoned again, my convictions aren't super high, but I am still leaning towards this way. I'm still positioned this way, and I still plan to add. Now that's the point that I was trying to make. Some members are having issues right now accessing the trade ideas. I have a developer working on that as we speak. And they couldn't get into the Apple trade idea. So what I did is I posted an updated chart for them. Here's the Apple trade idea. I'll keep this video for members. This is a beautiful, beautiful bullish falling wedge. Apple is just above, or just hit or just above. Keep pretty good support on the daily chart. Bullish divergences on a scale 1 to 10 from a bullish falling wedge. Back out all the long-term stuff. Just on the 60-minute chart, this is a 10. This is as close to a 10 as it gets. Very well-defined downtrend line, oversold, bullish divergences on both indicators, but we need a breakout. So far we had a breakout, but it was a failed breakout, number one. So here's the takeaway. I'm trying to give you lessons in trading. If you're trading Apple, if you didn't take it yet, I believe I added it on within the wedge in anticipation of a breakout. Sometimes I'll do that on a trade, but the conventional safer bet is wait for a breakout. But a couple things to that. Number one, I always talk about breakouts from bullish chart patterns needing to be, or they should be, impulsive. And if they're not impulsive, impulsive means on an increased volume. You want to see at least 1.5 times the average volume. Most brokers will give you the 60, 90, or 100-day average volume. Some programs will even show you the tracking volume. So far today, Apple is not tracking. I'm looking at another screen, and the volume buzz is showing it's tracking about 18% below average volume. So that is the opposite of impulsive. It's not an impulsive breakout, and as I always say, breakouts that are not impulsive have a much higher rate of failing. Doesn't mean they have to fail. So that's what happened. That's lesson number one on the breakout there above the downtrend line, the wedge. More importantly, Apple is one of the largest components, and it was for many years the largest component in QQQ, still one of the largest. And if you are Apple's not going anywhere without QQQ. At least it's not going to run hard. It could move up if QQQ drops. I've seen that happen before, but for the most part, being that this market, especially during times of impulsive selling like we've seen lately, indexing was what lifted this market to levels it should have never got to begin with. Just more and more money. The trend of investors getting away from individual stock picking, even mutual funds. They've abandoned to a very large extent the mutual funds of yesteryear, which used to have stock pickers at the helm who were outperforming the market. At least that was their job. But they did such a and over the past decade they've underperformed. The vast majority has. Some people have moved their money into index mutual funds and index tracking ETFs like QQQ and SPY. Now what that does, great when money is flowing into these things, because these ETFs then have to turn around and buy the stocks that they hold proportionally. And Apple, being one of the top holdings, is going to go up if QQQ is going up strong. Likewise, if QQQ doesn't go up, Apple's going to have a hard time going up. Now, the point that I'm trying to make is, let's get back, where was that chart I was looking at here a second ago? There it is. All right, so again, these are the levels laid out in pre-market, and that was a big one, that 177.20-ish. So we failed to break out. So far, 3 attempts. Doesn't mean we can't, and I'll tell you, and I said this in the trading room, I think if we get a run at it again, it will go. I think what happened is, and this is just me tape reading, I can't tell you this is definitively what happened, but I think there's a lot of people that weren't bearish at the top, or might have been, but were didn't want to short. Now they want to short because the market's going down. And so I think day traders, intraday traders, maybe even some swing traders saw that QQQ was failing on that bounce back to the 177.20 level, and they shorted. And so now I suspect that it will go up, and if we do go up, we get there again. They're going to start to get nervous. They're back underwater. If they shorted here, if they hit even if they nailed the top, you get back up there, especially those that shorted here and here and here, they're going to be underwater, and then they start to get squeezed. Their stops start to get hit. So, an objective trade, if you did short that bounce up to resistance today, is to short at at or close to or a little below 177.20 and have a stop not too far above it in case they pop it. And so this is where the stops lie right now. And I think so if we can get up there, we take it out, you're going to have buyers become emboldened because A, it's a breakout of that bullish falling wedge pattern, it's a breakout of the 177.20 resistance, which both come in together, and then B, you're going to have shorts start to cover. So that's the kind of the plan for today. Now you can take this as a day trade if you're an active trader. I do both. I'm a hybrid trader. I swing trade, trend trade. I have investments. I day trade in in my trading account. And so what my plan is to add. If I see that level go with conviction, I'll layer on. I'll add some more long exposure, and then the same thing in reverse with a stop somewhat below there. However, no breakout, no buy signal. So at that point, then I'm more concerned about stopping out of the longs that I do have, especially if we start to head back down. Look, as I said, you can think about a bullish falling wedge is it is not, as long as prices are in there, it's not a buy signal. It's not a bullish sharp pattern. It's you have a security clearly in a downtrend. That's the whole nature of a falling wedge, or it wouldn't be a falling wedge. And so you can continue down. And again, as long as the divergences are there and as long as we hold that support on the daily chart, we're good. But if we go much lower than that, so again, another cut of lows, and I'll say right now it's not looking great. They continue to step in, the sellers aggressively. So if you don't know what to do, if this kind of market, in this whole, hey, if it does this, then we're probably going lower. If it does this, we're probably going higher. If that confuses you, again, just focus on the bigger picture. If you've been scaling out, taking money out of 401ks, moving into safe assets, bonds, commodities, cash, there's nothing here that tells me that right now we're going to new highs. I can't rule it out yet. There's work to be done. Remember, that's a whole other, I've got the red, yellow, red, orange lines that tell me this is when we're cooked. If we break that red line down there on QQQ 152-ish, when we're far from it right now. So it's still anybody's game. And this wedge breaks out. Like I said, my upside potential targets on this from where we're at right now, maximum target, I'm not favoring that right now, but it's about 5.3% from where we're at right now. Oh yeah, and then back to the whole if you do it. I don't I don't encourage anybody to day trade if you don't know what you're doing. But when I refer to day trades, typically with a day trade, I'll just it's swing trading and fast forward. That's all it is. And if this breaks out, what I'll do, for example, is I would add to my QQQ longs NQ, which I'm trading in the trading account, and then reduce that exposure at the end of the day or trail stop. See, the nice thing about futures is, unless you're going into a weekend, they trade virtually around the clock. They have a period where they shut down briefly after the market closes. There's a 15-minute, I think, shutdown period, and then another hour between 5 and 6 for they reconcile. But then, there's nothing huge going to happen between there, so you don't have the risk of a gap. QQQ, you could wake up tomorrow and have QQQ. I've seen it gap down 3% or more in a day. And when it does that, it doesn't do it in a very healthy uptrending market. It does it during these corrective type phases once the correction's already set in and volatility's high. So keep that in mind, and there's no way to avoid that with a stop. Stop's going to just get bypassed. But futures, they'll roll over overnight, and again, your stops will get hit. There's so much liquidity in the NQ, E-minis, and ES that you can use stop loss orders, and the liquidity's there 3 in the morning that you're not going to have a horrible fill. So that's the protection. So, but point being, okay, let's just say back to on task here. Let's say you day trade QQQ. So you take a breakout there, and what you do is then you take an oversized position. It could be 3, 4, 5 times what you'd swing trade. Why? Because you have no overnight risk. You're going to close that trade before 4 p.m. today. And QQQ trades fairly actively in the after-hour session. You can even get out. If you didn't get out at 4, you have up until whatever it is, 7, 8 o'clock. So that's what a day trade is. And then if you like it, let's say the breakout happens. So from here to here, let's say it does this today. Let's just say it runs up and hits this first target, and we're getting close to the closing bell. So at that point, but you had a breakout, and you're going to hold out for, let's say, this resistance zone up here about 182 to 186. So what you do is you then close out the day trade portion of that position. I'll pick a round number. Let's say you swing trade and your average size is 10,000 in QQQ, so you could take a 30, 40, 50,000 position in Qs on the day trade on the breakout. Keep your stops tight. Remember, you're a larger position. You're going to have to manage your risk. Use a position size calculator to tell you what it will cost you if you're stopped out at X or Y or whatever level. But then again, at the end of the day, you would then reduce that back down. You like the trade, it broke out, everybody's getting bullish, you're bullish, you think the market's going to bounce for the next day or two or more, then you reduce it back to a swing trade position, so you're not at huge risk. So if you're back to your normal position size, in that case 10,000, and the market gaps down 3% the following morning, or let's say Monday morning if you took the trade home on Friday, then you lost $300, which is manageable for most people on a $10,000 trade. And however, if you took 50,000 home, 5 times your normal position size, that's going to sting you. And that's the difference between day trading and swing trading. And so this could be an opportunity for both. We'll leave it there. Let's just watch this level, wrap it up. I gave you my thoughts. Still leaning that way, and let's see if we can pop 177.20. And if we do the buyers step in aggressively? Do the shorts cover? Does all that pan out? There is a gap a little bit above it, so we might not take off. There could be a little reaction there all the way up to about 177. What is that? I'm trying to get the crosshairs on that. I'm referring to this right here, this gap from the other day. That's about 177.50. So really blue skies, I think, if we can take out 177.50. And finally on that too, if you are considering opening a long swing position or maybe closing shorts out, that's another way to look at this. I sometimes talk at how I'm positioned, what I'm doing, but I'll try to look at it both ways. So let's say you're short, been riding this down, you're going to stick with the trend until something tells you not to. Well, that breakout might convince you there. But also remember, it's Friday. We're heading now into 12:25 as I'm doing this video. By the time you listen to it, I'm sorry, it's Thursday. It'll be Thursday afternoon. Any swing position you take now, you have about a day, a little over a day and a half, a little less than a day and a half before the weekend comes, and you have to make the decision as a swing trader to go home over the weekend long, because you have the extra 2 days of overnight risk. All right, so we'll wrap it up here, and I'll do an update today at the end of the day, no matter what happens. This has been Randy Finney with Right Side of the Chart. Hope you enjoy.